Hello everyone, this is Sebastian McMahon from IA Financial Group and I'm back with the weekly review for the week ending October 13, 2023. Let's start with a look at this week's markets at the close on Thursday. Positive for bonds, flight to quality move this week following the geopolitical events in Israel and Gaza last week. Lower rates, meaning positive returns for bonds, and also lower rates helped bond stock market performance this week also. The price of oil was slightly higher after 4 days, but this morning, as I'm recording this, it's Friday morning prior to market open. We're seeing some new sanctions by the US on Russian exporters of oil, nothing to do with Israel, Gaza, maybe possible implication or not of Iran and all of this saga that could unfold. This is pushing the price of oil, as I'm talking right now, up by 3.5 to 4%. So we're more around $87 as I'm recording this, but it could be a very volatile day. Likely the picture will be different when it's all said and done today. But a flight to quality in the US dollar pushed the Canadian dollar lower, the euro lower versus the USD, price of gold higher. So this is the picture after a week. Let's dig into the inflation data in the US. That was the highlight of the week. Softer than in Canada. We're below 4% in the US, above 4% on an annual basis in Canada. But the recent trend remains too strong. On the left, you have the 3 months annualized pace of inflation in the US, total and core. And as you can see, the blue line, which is total, just reaccelerated to 4.9%, so close to 5%. That means that the last few monthly prints were hotter than previous prints. We're seeing a reacceleration. Price of gasoline, of course, is all over that, and there could be more of these pressures as the geopolitical tensions could fuel the price of oil. Let's see, but of course, this is something that we can reasonably expect. And also, we're seeing wage growth being too high. We still have strikes. We have the auto workers strikes that is getting worse right now, where we've seen multiple strikes recently and more are expected. So we could see more pressure on wages. That could lead to, we've had a flare up of inflation followed by a reacceleration in the 1940s and the 1970s. So central banks are trying to avoid that now. Let's see how able they are. But if you look on the right, the forecast for year-over-year inflation based on the month-over-month figures. Now, unless we have a sharp slowdown in the monthly inflation figures, which is not that likely because of the behavior of the price of oil right now, then we could expect inflation in the US to stick around 4% by the end of this year, which would be below Canada, but still too hot for comfort. Looking at the US economy now, maybe just some pedagogy here. This is what the NBER, the National Bureau of Economic Research, looks at when it makes a call for if we're in a recession or not, and the starting and the end dates of recessions. In Canada, it's the CD Howe Institute that does that. In the US, is the NBER. And here, those are, this is a drawdown chart. So every single line here, when you're sitting at the top, that means that you're at an all-time high. And when you fall, that means that you're falling from this all-time high, and then you're getting back to the all-time high. So just the drawdown chart here. And you have 4 indicators. You have industrial production, you have manufacturing and retail trade, you have personal income, excluding current transfer receipts, and you have the non-farm payroll, so the jobs numbers. What you see now when you look on the right of the chart is that we're not falling in any of these categories. In fact, some are still catching up to the recent highs, but also what you see, and the gray areas, the shaded areas, are previous recessions. What you see is that usually when you fall into a recession, you kind of fall very suddenly and everything turns around at the same time. So it's not easy to see recessions coming. It's not easy to time recessions, and we've been vocal on that in previous weeks and in one of the latest monthlies that we've put out, that the quarter just before the start of recession usually are posting very decent growth. So when recessions start, they tend to start abruptly. So good message here, the good signal is that we are not in a recession now. Good news. But the other more ambiguous is that, well, when we fall into a recession, it's hard to time it. You tend to fall, just like that. Of course, with the massive tightening of monetary policy that we've seen, it's normal to expect some economic slowdown. We still expect some sort of a mild recession in 2024 in the US and in Canada, same thing, based on the tightening of monetary policy, but we're not there yet. And talking about central banks here, shifting to this chart here, you see the global monetary policy cycle. So the shaded area in the chart is the number of, we track about 30 major central banks here, number of them that in the last 3 months have hiked, that pushes the lines lower, or eased cut rates, so ease monetary policy, that pushes the lines higher. So what you see now is that emerging market central banks, now we're in positive territory. So over the last 3 months, there was one more emerging market central bank that cut rates than those that hiked rates. So we're starting to see some easing there. And emerging market central banks were able to, they were very proactive. They started hiking rates before developed countries. They were able to tame inflation easier than the developed countries, and now they're starting to cut just to give some breathing room to their economy. In developed countries, we're also starting to see some cuts, but not in Canada, not in the US, not in at the ECB, not the BOJ. So it's not the major central banks that are acting here. But the good news here is that you're starting to see central banks adjusting, falling into the other side of the spectrum of hikes and then cuts. So starting to add some air. Some countries have been able to tame inflation. Good news, and we're starting to see some more stimulus, or at least some less tightening globally. But this is just for rates. When you look at the balance sheets of the central banks, following quantitative easing, when the central banks are injecting money in the markets and the economy, then after that there's quantitative tightening when you need to unwind that, while the QT continues. Now on the right, there's still a lot to be done, and in fact the Bank of Canada has been one of the most proactive in its quantitative tightening. Close to 50% of the money that was injected by the BOC during the pandemic has been taken out. So that's good news. But here, what you see is that there's a lot of room until we're done. The numbers on the right, they're trillions of dollars, so it goes quickly, and we're still seeing some tightening there from quantitative tightening. So what you see is globally, rate hikes are less prevalent, and we're starting to see rate cuts, but the normalization of balance sheets is restrictive, and it continues. Finally, geopolitics and Wall Street. It's hard to find a good signal there. Geopolitics tends to impact market volatility, but here this is a table we borrowed from Strategas. They define major geopolitical events. It's their definition. Everyone has their definition. Here you have lots of events, so you can take a look at that and focus on the ones that speak more to you. But the message here is that on the day that these geopolitical events happen, you tend to have a negative performance from the S&P 500. This is only for the S&P 500. After 3 months, 6 months, 12 months, you tend to be back in positive territory on average, but the average tends to be below the unconditional long-term return of the stock market. So it does tend to be a headwind to equities, but it's not like there's something very telling here in this table. It just creates volatility. Every event is different. It can impact the price of oil, it can impact interest rates, can impact currencies. So depending on what the event is and the channel through which this impact is diffused into the market, can lead to the very different market reactions. But so far, here's a table. So it's kind of a guide. It's creates volatility and lower growth on the S&P 500 for the year following that. But again, other than that, there's not much info to be taken here. Just wanted to share that with you. So what to watch next week? In Canada, we'll have the Bank of Canada Business Outlook Survey. We'll have housing starts, CPI, inflation, retail sales. In the US, we'll have retail sales, industrial production. Both of these were part of the chart that I showed earlier about the recession indicators, so interesting to follow. Building permits, housing starts, and existing home sales. So we'll have some data about the state of the housing markets in the US. So that wraps it up for the week. 2 places to find us, ia.ca/ iagam.ca/economy and iagam.ca/insights. So there's ample material out there. Always a pleasure to serve you, and I'll be back again next week.